Hey everybody, it's Michael Martin. Thanks for being here. So look, markets have been pulling back, maybe not the S&P, but some of the stocks, at least the ones I've been like EOS, Energy and Riot and Rigatoni, RGTI. And it's very tempting to think like, man, these things were the high flyers and the darlings and have gone up twofold, threefold, fourfold in a very short period of time. But they also correct very, very quickly. You know, I estimated that sometimes it can take about one-fifth the time it takes to get to a certain high than it does to actually unwind. And with Riot, you're looking at almost a 50% pullback. So I guess the point I'm trying to make here is be careful. It's not like you're trying to pick falling knives, but when there could be, very good fundamental growth potential, you have to remember that as a trader, lower prices does not mean better value. And so if you did make money for a good chunk of last year, or the second half anyway, in some of those names, be careful before you kind of start falling in love with them and trying to go back to the same well. The move for the near term and for quite some time actually could be over until the stock gets a chance to kind of regroup and consolidate. You don't necessarily know where the bottom is. So stick to your rules, keep an eye on it, maybe put an alert on. And this goes for commodities too. Like when they're in a bit of a free fall, the best thing to do is to stay on the sideline and sit on your hands. And if you can't find names to trade, then the best thing to do is to take some time off rather than force a bad trade and end up losing money by being in trades that you had no business being in the first place because you couldn't find a winning strategy or your winning setup. Obviously I had to learn this the hard way, perhaps like you did too. And I did it enough where I was like, that's stupid. I'm losing money. I have no business being in here. There's no real sign of life here in the stock. Why do I keep coming back to it thinking it's going to bounce? So what I ended up started doing is letting the thing bounce and then kind of catching the move to the upside. Another rule that a lot of traders use in the swing trading realm are, they wait for the name to be above the 5-day simple moving average. So with these big volume days, you can certainly anchor VWAP. You can look concurrently at like a 5-day simple moving average just as a screen to see like, is the security that you were in that you're now not in because you got knocked out. And let's face it, there are times when stocks take a breather and they're making a base inside of a stage 2 uptrend, and they sometimes leak below support, you get knocked out, and once in a while you can kind of get back in. But when you see the trend has completely turned and it's moving lower, you want to protect your cash. That's a huge part of this business. It's not just finding the winners to jump on and then add to your winners and manage the risk accordingly. That's obviously part of it. But in terms of the mental game, you have to learn to stay out of it as well. And sometimes, they do say you got to dance with the girl who brought you, but man, I can't tell you how much money I lost in the early years by kind of going back thinking like, okay, this was just a breather, because I didn't have a good understanding of continuation patterns, which I had to learn through experience. And I didn't fully understand the nature of stage analysis. I didn't have a strong understanding of trends because I just didn't have any trading experience. And you really have to kind of live through it. You can't study it necessarily in a book, because what happens is if you look at some of the websites where, you go to bar chart and you look up Riot, it'll still stay strong buy, and the thing's down from 24 to like 13 today or something like that. So the fundamentals will change only after the price moves, right? That's what, Paul Tudor Jones has been quoted as saying, I believe. Price moves first and the fundamentals follow. And even if it is somehow a strong buy in the space that it's in, you can learn a lot by going back to, say, look at the sector that it's in and see what the relative strength of the sector looks like. So start with the sector, then look inside the sector to see what are the best names to be in and what their relative strength is. Because, man, the volatility can kill you. And, I'm not talking about investing. I'm talking about, certainly trading. And then you have to take a look in like some of the red bars. If you use green for the up days and red for the down days, you have to be mindful that the volatility could expand. So even if you do get back in, your position sizing might be drastically cut given the prevailing volatility. You might also notice that, the option prices have implied volatilities now of over 100. So it's very, very difficult to even play the options game. So love yourself enough to not force a bad trade, because I can promise you this, the market's not going to treat you nicely just because you're you. I'm a good guy. Yeah, well, so am I, but the market doesn't care. And when those types of things happen, you're in a sell-off. People are trying to, perhaps, I don't know, it's probably we're 6 weeks from 12/31, so I wouldn't know that it's window dressing, but you just never know. In that people are unwinding positions to protect their gains, coming into Q4 and also year-end 2025. You want to be very, very aware of that the market, you want to stay long overall as the trend is moving up, but the economy is it's not as clean as the market, for example. So stick with the trend and stick with your investments, but just realize that you may find some very, very sharp moves in the market coming into the end of the year because of the nature of how the news hits the tape, and then how much people are going to try to scramble to protect their cash, i.e., protect their track record. Both, because you have, some people look at it monthly, which could be like November. They could look at December. Some people look quarterly, Q4. Then they have year end 2025. So it's a lot happening, and that's, before earnings. So be careful, protect your capital. Don't rush into things for the sake of rushing into them. There'll always be another time to get in. Wait for something to consolidate if you can. V bottoms are very difficult to trade. And just realize that, there's some idiomatic expressions. There's no stock that's too high to buy in price, and there's no stock that's too low to sell short. If you look at the NASDAQ, the open short interest on NASDAQ stocks, sometimes the ones that have like 75% short interest, meaning if there's, 10 million shares, 7.5 million might be borrowed for the purpose of selling short. So they would call that the short interest would be 75%. And the stock could be like $1.80 down from 20. And you say to yourself, it's not like it can go back to 20. But if you're selling something that only has $1.80 downside and you're still short, why are you still short? So those things can move very, very sharply. They can still go down. They can go to zero. They can go from 180 to 60, which, don't forget, as the old saying goes, it's at $1.80. How much more can it go down? 100%. So don't forget, if it goes, from $1.80 to 90, that's a 50% hit. So be mindful and think in terms of percentages. And remember, what you don't lose, you don't have to earn back. So I tend to be very, very stingy with giving back, realized and unrealized gains. If I'm in a winning position and I'm going to add to one, I tend to invest my gains into my protective stop. So, if I have a stock at 20 and I buy more at, say, 26 or 28, you figure out the midpoint then is 23, 24. I'll put my protective stop above the midpoint so that, yes, I'll lose some on my last entry, but I'm still going to walk away net a winner because of where I place my protective stop. I call that, and many of the old timers that mentored me, we would talk about investing our gains into our protective stop. So that's a mandatory way of doing things if you're taking risk home overnight. And also measure volatility. Look at the dollars dollars and cents, because you have to use that. Obviously, ATR is a good measurement of that. But at the same time, you might be mindful to think like, if you have a $10 stock with $1 daily vol, and then you have a $20 stock with a $2 daily vol, the volatility has still maintained 10%, right? 1/10 equals 2/20. But you still have to position size on the two. Maybe you cut your position size a little bit to take, into account that the shares are much more expensive. So risk management becomes the one, of paramount importance when you're in these types of markets. Give yourself a pat on the back if you even already have this stuff in your consciousness, because this is what makes trading very, very difficult, in knowing when to go and be fully invested, knowing when to even start to use margin, right? And then two, as you get knocked out, knowing when to stay away, because you could always get back in at another time. But sometimes you'll have to give these names enough time and enough space to kind of fix what the chart looks like, because one of these are not necessarily bloodbath, but kind of getting there where there's a lot of selling. And I think it's probably because people have made a lot of money, they had big positions, and now they're kind of unwinding those positions to protect their cash and protect their capital, protect their track record. Right? When I was starting out as a manager and running my own money, I knew that I was going to be marketing my track record. So there were times where, if I was up, say, 13% for the month, in my mind, I knew like I wanted to print a 10% come the month's end. So I would say, okay, of the 13, I have only 200, maybe 250 basis points that I'm going to risk between now, and the end of now and the end of the month. So the earliest you can see this, let's just see, is going to be the 17th. Today is that you're watching it is the 17th. You got another 13 days. So if I was up 13%, because I was largely in commodities, and that could be the case, given the leverage, I knew I was going to print a 10 spot. And so if I did nothing but lose money, so that my monthly returns were like 1290, 1250, 1220, 1180. I knew that at one point, even if I had to take the last week off, that I was going to do that, because it was tactically advantageous to me to print that number in my, not my risk disclosure. Yeah, I guess it was my DDoc, my disclosure document, which, is mandatory for NFA member firms. I wanted that double-digit number. Now, is that necessary? As a discretionary chart reader, people could say, "Oh, well, you chickened out." But yeah, I know. But at the same time, people are looking at your returns per month, and if I could put up a 10 spot and only have, maybe a 2% monthly drawdown, or a worst month drawdown of, say, 2%, the investor's sitting there saying, "Okay, on good months, it could be as much as 5 times what the biggest losing month is." If you're not running public money, or you don't want to, then this conversation probably doesn't matter too much to you. But I was always thinking, like, I can grow my own money now that I know how to do it. But if I'm also taking 20% incentive fee, or even sharing part of an incentive fee, I'm going to make more money, which I could add to my own account, which I could compound even that much faster. So it all kind of figured out in the big chess game. You have to remember, what are your goals? What is your why? Why are you doing what you're doing in the marketplace? And why are you trading? Is it to grow your own money? Is it to build a business? I was pretty clear about what it was that I was trying to do. And so that I made sure, I married my beliefs and my goals with my behavior, because it was the behavior that's going to predict where you end up. And that has made all the difference. Having that in my consciousness really mattered, quite a bit. And it helps you navigate. When they say you have to be pilot and navigator, that really helped me a lot in making, making my decisions, which could mean adding risk, removing risk, or the third option is not doing anything. Because you have to remember, most of you are probably, if you're discretionary chart readers, you're on the speculator side. And the one cool thing that speculators have, and I'll leave you with this, is that you have the right to not participate. If you were, running $1 billion for anyone at an RIA, or if you're a CTA and you're charging a management fee, you can't be in all cash. There's only extraordinary circumstances where you'd be in cash getting a 1% or 2% management fee when, there's no management going on. That's hard to support over longer windows of time. It is possible that you might get knocked out of trades all at once, and for a short window of time, maybe a week or so, that you're in cash. But if it goes on for like a month, your clients will definitely ring up and say, "Hey, can you give us a break on the management fee? Because we've been in all cash." So you want to be mindful of that. Anyway, please like and subscribe. Many of you watch the show, but you're not subscribed to the channel. And if you're new here, thanks for being here. Please go to the link below and you can download a free copy of the audiobook version of my book, The Inner Voice of Trading. Have a great week, folks. I'll see you next time.